Welcome back. The recent market rally may give some investors a reason to be optimistic in this bear market. Our next guest says he has 3 reasons to be optimistic right now, including signs the Fed's plan might be working. We're joined now by ProShares global investment strategist Simeon Hyman. Simeon, great to have you here in studio.
Thanks for having me.
Okay, first and foremost, when you think about the reasons to be optimistic in U.S. equities, I mean, some of that has to be based on where valuations and the compression that we're seeing right now, where they sit at this point.
Absolutely. You got to start with valuations. We're trading around 16 times 2022 expected earnings. Look, we still have a 4% 10-year that's still historically reasonably low, supports on average something around a 20 PE. So if we do this math, that tells me that we could miss consensus expectations by at least 10, if not 15 to 20%, and still be in line with 16 times consensus, which might turn out to be 18 plus times what actually turns up.
So that's the valuation piece. We also put up some of your other reasons that the Fed may be achieving their objective and the U.S. economy is relatively well positioned. If we take the second of those, the Fed may be achieving their objective. But if the Fed doesn't think they're achieving their objective and they keep going, that's really the fear of people, right? Is that they're going to keep going, overshoot, and then push the economy into a recession.
The evidence, let's start with the evidence first. The break-evens are the big piece of evidence as far as we're concerned. So they have come way, way down. Yes, over the last couple of weeks, they've poked up a little bit, but you had break-evens on the 2-year at about 5% earlier this year. They're down to about 2.5% right now. That's getting close to the 2% mark that the Fed's looking for.
And do you think the Fed is going to be watching the break-evens?
I think we have to be cautiously optimistic that we will. But the wild card is employment. If the employment market stays as tight as it is, that's where you get a little bit of the tension.
We're getting into what usually is a seasonally good period for the markets. Do you think that seasonality will remain intact given where we are with the Fed, given how low markets have come down this year?
I think there's 2 ways to think about it. If you're looking for a little bit of a shorter term perspective, then you want to lean into the sectors that are likely, as an example, to do well in earnings season. We're seeing pretty decent numbers for the financials right now. You know, we have an ETF, EQR, our equities for rising rates. It piles into energy, financials, materials. That's your best bet for outperformance near term in the earnings season and kind of a, if you will, a 3, 6, 9, 12-month horizon.
When we look at the B of A Fund Manager Survey today, one of the things that sticks out is that we are at the lowest level for some of the investors, the institutions, to really insert some type of speculation within their portfolio or take on risk. And that risk aversion right now at one of those lowest levels since 2008. And so when is it safe to start kind of picking at some of the more kind of speculative names that have been hit as a result of either policy or whether that just be because there's no real earnings to show for some of those companies?
So I come from a trust company background, and we weren't big sentiment folks really trying to call the bottom. But I think you want to play this, I don't want to call it a barbell, but I mentioned just leaning into the sectors that are likely to outperform in the near term. And that's a shorter time horizon. Again, not in days for us, but in quarters. But if you're looking for a place where you don't have to worry about the inflection point, it's those consistent dividend growers. Our ETF, which we always talk about, NOBL, it's the S&P 500 aristocrats. The quintessential hedge against inflation is rising dividends. And if you look to those consistent dividend growers, you don't have to worry about the bottoms tomorrow. Is it next month? Is it even a quarter from now?
We haven't talked about crypto much lately, and yet it's the 1-year anniversary of a crypto ETF that you guys came out with, BIT or BITO, as you guys call it in-house, I guess. And I'm curious how it's been doing. I mean, because it's sort of, Bitcoin has sort of fallen out of the headlines to some extent.
It's been a volatile period, and what we're very proud of about BITO is that it's done exactly what it's supposed to do. It has tracked spot Bitcoin really, really well, and folks didn't think that was going to happen. They were all worked up about the roll cost, but if you open up a finance textbook, this is a non-yielding thing. It's a financial future. You don't have to store it in tankers out there. So therefore, the roll cost should be equal to the short-term interest rate. And BITO holds cash such that it earns interest on the cash about equal to the roll cost. It's tracking it spot on. It's the largest cryptocurrency in the world, and it trades really well. So when you put that together, whether your time horizon is a short one or a buy and hold, it's really moved to the fore as a vehicle of choice.
Always good to get some time. It's good to see you in IRL, right? In real life?
IRL.
All right. Simeon Hyman, ProShares Global Investment Strategist. We'll talk to you soon.